All right, so good morning once again. So we continue from where we ended the last time, receivables management. We solved the example 1. We'll be looking at example 2 today, that is with respect to the receivables management. So someone should take us through the example quickly. 2.
Example 2. A company has sales of 20 million. Customers currently take credit as follows: days and age in percentages. They are considering offering a discount of 1% for payment that 60%.
Is it from my end? Your line is
overdraft rate is 15%.
hello. Your line is breaking. Can you
Pardon?
or is it from my end? It looks like your line is breaking.
Calculate the net cost of benefit of the change of policy. Today offer
Start
the
again.
discount.
Start again. In fact, start again.
Yes. Example 2. A company has sales of $20 million per annum. Customers currently take credit as follows: days, 30, 60, and 90, aging percentages as follows. They are considering offering a discount of 1% for payment within 30 days. It is estimated that 60% of customers will take advantage of the discount and that the remainder will take a full 90 days. The company's bank overdraft rate is 15% per annum. Calculate the net cost and benefit of the change of policy. So they offer the discount, assume 360.
All right. So this is also part of the receivables management. So yeah, they are asking us whether they should offer the discount to the customers or not, right? And they say we should calculate the net cost or the net benefits of the change in policy, right? So they were having an initial policy, which is what we are seeing here, and then now they have made some adjustments, and that becomes our new policy, right? So comparing the new policy and the current policy and determining the net cost or benefits, we'll be able to tell if they should offer the discount or not, right? So this is somehow similar to what we did in example 1, right? And that is in the previous video. So basically, you have to determine the cost of giving the discount, right? The cost of giving the discount to the customers, and also the benefit of giving the discount, right? So if the cost, comparing the cost and benefits, you see, you would actually be able to tell if it is a net cost or net benefit, and we'll be able to make a decision there. Of course, if it is a net cost, we would say that they shouldn't offer the discount. But if it's a net benefit, we will say that they should offer the discount. All right, so we have a sales of $20. Is it $20,000? $20 million. Sorry, $20 million. And we've been given a days of what? Days as 30 days, 60 days, and then what? 90 days. Then the percentage in what? Age. the percentage age of what? Of the receivables. So we have 20%, right? We have 20%, and then we have 50%, we have 30%. So the percentage total will be what? 100, giving us 100%. Right. And they said they are considering to offer a discount of 1% within 30 days, right? It is estimated that 60% of the customers will take advantage of this discount. Oh, okay. So the discount is only for 60% of the customers, right? So the 1% is just for the 60%. And the remainder will take a full 90 days, right? The bank's overdraft. So we have been given overdraft here. Overdraft as what? 15%. What else? So that is it. So now let's determine the cost of giving the discount. What is the cost of giving the discount? Then we also do benefit of giving the discount. Cost of giving the discount. Cost of giving the discount. So what is the discount? What is the discount? The discount we were told is what? 1%. But this 1% is taken by 60% what? Of the customers. And this is 60% of the what? Of the sales figure, which is 20 million. Right. So this will give us a discount, and that will be the cost of the discount, right? That will be our cost because it is discount that we are giving to our customers. So it is a cost to us. So 1% of the 60% times the 20 million should give us a discount. What are we getting?
$120,000.
So 120,000 is basically the cost of what? Giving the discount, right? That is the cost of giving the discount. We'll come and do the benefit of giving the discount. But before we move to the benefit of giving the discount, let's try to analyze the current receivables to know the number of the average receivables. So let's analyze the current receivables, the period, right? Current receivables period. So we have 30 days. 30 days, 60 days, and then 90 days. So now, we are told that these 30 days would attract what? 20%. So 20% will give us how much? So this will also attract what? 50%. And then this would attract what? 30%. So what is the number of days? For each of them, what is the number of days? We're looking at the average collection period. This one is what? 6. What is this one giving us? 50% of 60 will give us 30. 30%. 30% of 90 is what?
27.
20 what?
7.
So now the summation of all of these will give us the receivables what? Period. The summation of all of these will give us the what? The receivables days, which is what?
63.
63 days. Right? 3 days. So now this is the receivable days, but we want the average receivables, right? We want the average receivables. So what is the formula for the receivable days? So the receivable, from the formulas we look from the beginning, we say receivable days is equal to what? The average receivables
Over credit sales.
over what? Credit sales times what? Here they give us the number of days from the question.
Yes.
Is it 365?
Yes, please.
So 365. Now we want average receivables. So what do? We want average receivables. So we are going to make average receivables the subject. So here it means that receivable days, this one will multiply times the what? Credit sales is equal to average receivable times the 365. We want average receivable. We divide both sides by what? 365. This one will cancel this. What is the average receivables? That is the receivable days times the what? Credit sales, right? All over what?
Yes.
365. So basically the average receivables, let me write it in full. Average receivables is equal to the sales, credit sales times what? The receivable days over the 365, right? Over the 365. Since the number of days over the total number of days, right? The days over the total. That is why I give it to this one. It's still correct. Okay, so from this, what is our average receivable? We have been given a sales, so we assume that this is the credit sales. The entire thing is the credit sales. So that is 20 million times the receivable days. What is the receivable days that we computed? 63. So 63 over 365. What are we getting? Hey, what are we getting?
$3,452,054.79.
Mention the figures one by one for me as well.
3452
3452
054.79.
3452
054.79.
054.79. So let's run it to the nearest whole number. So 0.055, right?
Yes.
Okay. So this is our old policy, right? This is the average receivables for the old policy. Right. So let's do the new receivables. The new receivables for the new policy. Or let's say the new receivable balance as a result of the discount. As a result of the discount given. The new receivable policy as a result of the discount was given. So we have the days. We said 30 days, right? So they said they are considering offering a discount of 1% within 30 days, right? So this 30 days, it is estimated that 60% of customers will take advantage of the discount, right? So 30 days would attract 60% people, will attract 60% people, right? So that is giving us how much?
$18.
18. Is it that you don't have calculators in the class? All right, so now, and I say that the remainder will take a full 90 days. The remainder, so the remainder is 40%. 40% is the remainder. They said they will take a full 90 days. So 90 days times the 40% is given us what?
That's 6.
So 36. So 36 plus the 18 will give us what? That's the receivable days.
54.
So now, let's find our average receivables. What is our average receivable? The average receivables is what? The credit sales, which is 20,000, times the what? Receivable days, which is 54 over what? The 365. So what then is our receivable, average receivables?
$2,958,904.11.
2958
90.11.
90 what?
4.
4.
904.11.
Point.
So 90.
Okay. So that is it. So now this is our average receivables after giving out the discount, right? So after giving out the discount, so look at this. Without the discount, look at this. Without a discount, we are supposed to take this amount from our debtors. We're supposed to take this amount from our debtors. Oh, that give us this money. You are owing us receivables at the current asset side. At the current asset side, we are supposed to take 3452055. That is the receivables. But after inculcating after we introduce the discount policy that we'll give you 1% discount, right? After we said that, that having an average receivables of just 295894, is it a good thing to introduce the discount based on this?
No, please.
based on this scenario that I gave, is it a good thing to introduce the discounts?
I'm not really getting the question. So you are comparing the answer you got from the receivables without the discounts, and then you are comparing the amounts with the discounts, right?
Exactly.
You're asking whether or not we should take with the discounts or not, right?
Yeah, based on this, because initially our customers were owing us 3452055. That is without a discount. They were owing us this amount. How do we get this amount? So we said, because we want to get this amount, we have introduced a 1% discount just to encourage them or motivate them to pay their amount that they are owing us. So after introducing the 1% discount, they said that 30 receive 60%, and then the remaining 90 will be 40%, and we have 54 days, and we have calculated the average receivables, and we are getting this receivables now. So I'm saying that comparing this figure and this figure, what do you think? Comparing this figure and this figure, what do you think?
Well, I think we should not give the discount. Oh. Because it's lower.
Yes. Yes.
Yes,
But if you are comparing the days and the business is in agent of like cash flow something, then I think they will go for the policy that they've introduced. But if their cash flow is stable, they're able to meet their liquidity problems and everything, then I think they shouldn't go with the policy.
Okay, but it seems you guys don't get what I actually want. But what I'm saying is that now we were supposed to, as a business, we don't want to have a lot of receivables in our book. If you have a lot of receivables in your books, it means that your money is with other people. We as a business need a lot of money, and now we have a lot of receivables in our books. It means that a lot of our money is with what other people. Now, after introducing the policy, we are now left with 295894 to collect, and that is good. It is good because now our receivables have reduced. We're supposed to be taking 39, but now it has reduced to. It means that the policy is being effective. It's allowing us to be able to collect our receivables, right? So it means that based on these two comparisons, we can say that there is what? There is a fall in the receivable balance as a result of what? The discount. So there is a fall. There is a fall in the receivable receivable balance, right? As a result of what? Right? There's a fall in the receivable balance as a result of what? Of giving the discount, or as a result of the discount given, right? So you see that the fall is what? What is the difference? We are having 3452055. 3452055 minus what? 2958904. So this, what is the difference?
$493,151.
Sorry, what is the difference?
493,151.
493,151. 3151, right? So this is the savings, right? The savings that we are getting as a result of introducing the discount, right? So this is the savings. Now let's compute the interest on the savings. What will be the interest on these savings? That interest on this saving is a benefit to us. That interest on this saving is a benefit towards us. So interest on savings. Or let me say interest is
saving. Because I think that because if we had waited for the 63 days, we would have gotten the 3,400,000 and something, but then we introduced a discount because we needed them to pay fast. So that doesn't mean that we are rather losing that money. Because the discount was
continue.
Yeah, the discount was introduced that they'll pay faster. So that means okay, we are going to let go of this amount that you've gotten to be able to get our money. Sorry, to be able to get our money at that date, the 36 days. So I think that I feel like the difference should be a loss rather than a gain, because that's as a result of the discounts. The difference between the money we would have gotten and then what we actually have because of the discount.
No, look at the name given to you. This is what average was. What is the name?
Receivables.
Average was receivables. Average receivables. This is the amount that is left in our statement, our financial position to receive. I'm sure you've done cash flow, or you do it second semester. Are you doing cash flow this semester? Cash flow statement. I think financial report, okay, it will be next semester. So if your receivable balance is 10,000 in your books, and now your receivable balance is 8,000, this is a positive thing. Receivable should not be too much in their books. It means your money is with other people. So once it has reduced to this amount, it implies that you have received 2,000.
Okay.
What I say? So I think you've not done the cash flow. That will be second semester financial reporting. We'll do that. So if your receivable is 10,000 in the books, and now you've introduced a policy, a strategy to reduce the receivable to 8,000, indirectly means that we have actually received 2,000. That is a meaning, and that this is a positive thing. We have saved 2,000 from the 10,000 that we are having. Do you get it?
Okay. Yeah.
So that's why I'm saying this. Okay.
So in respect with the question that we're solving, that means you received 493,151.
Yes, that is the amount we are saving as a result of introducing the discount.
Okay.
Because our money is with them. We're having 3, 9, is it 3, 4, 5, 2 with them. Now, exactly. We will want a strategy to just collect our money. Because if you don't take 10, the money keeps long with them, it will become a bad debt. Then you see that the customers, some of them are no more living, right? Some of them have gone bankrupt. Then you see that our money will be left with them. But because of reintroducing the discount, it's a strategy. Now our average receivable is now 2,958,904. It means we have done a positive thing just based on this. Means our receivable has now reduced, and that is a good thing for us. I think someone was about to say something. Hello, is someone saying something?
Yeah, please, it's me, but I think you have elaborated on it. So I think she was looking at it from the perspective of cash, but receivable does not mean income or you have to receive the money. So receivable is just like your debtors. You have debtors. So you are just taking a new policy in order to reduce people that are owing you. So if your new policy has been able to reduce the amount of money that people owe you, then it is an interest. I don't know if you are getting it, but I think you have explained that.
It's an inflow, right?
Yeah, absolutely.
This Maclean.
Come again. Are you talking to me?
Yeah, I'm saying, are you Macklin?
No, please.
Your name?
I'm Prince. I think I've spoken to you before.
Oh,
Just
okay.
behind the city conference. All right.
Oh, sure. Thanks. So you see,
You're welcome.
it is not like an income, right? Receivable. So once you reduce your receivable, it's an inflow, right? So now, what is the interest on saving this inflow? You've been given a discount rate, right? The company's bank overdraft rate per annum. So this discount rate will be used to compute the interest on this receivable, right? Which is 493151. What are we getting? So now let's look at the benefits. Let me actually write the benefit. The benefit of giving the discount. What is the benefit of? You look at the cost, right? Cost of giving the discount. Now the benefit of giving the discount is basically the interest savings. The interest that we are saving on as a result of giving the discount. So interest savings will be what? That will be the 15% of the 493151. And that is giving us what?
Seven,
73972.
7397 what? 3. Right?
2 points. Okay.
2 point what?
65.
2.65. And then if you want it to be 3.
Yes.
Right. So now, from this, it means this is the only benefit you get from giving the discount. Now, as to determine the net cost or benefit, will it be a net cost or a net benefit? What is the cost of giving the discount? What did we get? Cost of giving the discount give us what?
Yeah,
That was
120.
120,000. And then the benefit of giving the discount give us the 73973, right? So is it a net cost or a net benefit?
The net benefit.
120. The 120 is a cost. So let me put the cost in brackets. Plus this is the benefit.
It's a net cost.
73. So is it a net cost or a net benefit?
A net cost.
The net cost of how much?
Of 61,9723. So
61.
619,9723.
Nice. Another 9.
No. So 61,9723. So it's just
61.
9723.
So 723.
Yeah.
So this is our what? Net cost, right? So it is a net cost. So what do you think we do? Since it is a net cost, what do you think we do? Do you offer the discount? Do you offer the discount? 120,000 plus
No.
7.
46027.
Is it supposed to give us this huge figure?
46027.
46027.
027.
That is 120 minus 73,973, right?
Yeah.
Okay. So do we offer the discount?
Yes, please.
Oh,
I don't think so.
should we offer the discount, or should they offer the discount? They are getting a net cost too. If you are doing something and you have cost and benefit, and you net the two of, you are saying that you are getting a net cost, will you continue to do what you are doing?
No.
So therefore, do not offer the discount, because it is giving us a net cost, right?
I thought
Any
like
question?
we'll compare it to the bank overdrafts, like what that one is giving us before we decide whether to give the discounts or not, whether to take the discounts or not. Or because this one we have a net cost, so immediately you will not take the discount policy.
Yeah, so this
Yeah.
one is basically, I think we are speaking from the previous one that we did, right?
Yeah.
Uh-huh.
Now
But
you
this
compare.
one, we want the cost, right? And the cost, we have been given the cost as what? As what? The cost will basically be the discount. And the discount that we
Okay.
are given, that will be the discount that we are giving out. So we just have to compare net cost and the net benefits to be able to take a decision on this. So let's look at example 3.
Mm-hmm.
Example 3. Hey, am I recording?
Yes.
Yeah, okay.
So example 3,
Okay.
shall I read it?
Yes, please.
Our sales are $1 million per year, and our customers currently pay as follows. So we have the month, we have the percentage of time. So for the first month or 1 month, 20%, 2, 30%, and 3, 50%. So we are considering whether or not to factor our debts. The factor will pay us 100% of debts after 1 month. I can't see the rest of the. I think there's another statement there. Then it says the fee is 2% turnover. As a result, we will be able to lose some credit control staff at a savings of 20,000 per year. The company's bank's overdraft rate is 18% per year. Calculate the net cost or benefits per year of changing to the new policy.
Okay. So this question is based on factoring, right? I think last week I talked a bit about it, a little bit about it. So even before looking at this question, let's talk a little bit about the factoring. Okay, so let's talk about debt, debt factoring, and invoice discounting. And invoice discounting. Right. So the debt factors are specialist organizations, right? Sometimes organizations or businesses um, or companies don't know how to get their receivables early. You see, sometimes when you want to get your receivables, it sometimes becomes difficult when you go yourself. You're like, oh, customers, you have done all the needful. I think I gave the but sometimes you would what? You would call the person all the time, send the person remind letters, give the person telephone calls. You may even decide to withhold the supplies that you are giving the person. Then you may see that all these activities, all these factors are not yielding the result, right? So what do? You hire a debt factor, and I think that the debt factors are specialist organizations which specialize in in assisting clients from client firms to administer their trade receivables, right? So basically, it helps them to get their receivables. So these people are like police officers who would go and take the debt for the companies, right? And they do that at a fee, right? They do this at a fee. So they help in one assisting client firms to administer their trade receivables. Trade receivables ledger. Two, they provide short term. Sometimes, you see, they are going to take your receivables for. Sometimes they give you, and if your receivable is 100%, right, they will sometimes give you 80%. That you keep the 80%. We'll go and fight and get the receivable. Once we get the receivables, we'll bring you the 20% less our service charge, right? So they sometimes provide finance. So provide short-term what? Finance. Provide short-term finance to client firms. To client what? Firms. And that is secured. This short-term is secured on what? On the receivables. Secured by the trade receivables. Right? And also they provide insurance. They provide insurance. They provide insurance against any bad debt, right? Insurance against bad debt. Insurance against bad debt. So that you will not get any bad debt, right? You will not get what? Any bad debt. So this is basically the work of the what? Factoring, debt factoring specialists, right? So they are called factors, those who take the money on your behalf. So I give example like we said quick credit, whereby they will be going on people to take their loans, right? So sometimes they can hire third parties to do that on their behalf, and these third parties, they make sure that whatever they do to get their money, they will do it and get their money, right? And then invoice discounting is invoice discounting. So sometimes they can say differentiate between invoice discounting and then debt factoring. So invoice discounting is basically when the firm uses its invoice or the trade receivables to secure funds from the bank. Is when a firm uses its trade receivables and invoices, trade receivables or invoices to secure funds from a bank. To secure funds from a bank. Right? So once they use their trade receivables as collateral, right, to secure funds from the bank, and the bank will not give them the exact amount on their receivable. They'll give them something lower than that, right? They'll give them something lower than their receivables from a bank. And so let me say the bank gives the firm a percentage. The bank gives the firm a percentage lower than the invoice amount, right? That is the receivable amount, invoice amount, right? But takes, so they will give you something lower than what the receivable. But then when they take the receivable from the customers, they will take the full amount, right? But take the full amount during when it matures, right? During maturity. So example, they will give you like they will give you 80%, and then when the receivable matures, it's time for the customer to pay. They will take the 100%. It will take the 100% from the customer, right? From the customers, right? So that is the difference between the debt factors and then the invoice discounting. So debt factors, you rather hire people to chase your debt for you, right? And then you provide them some, give them service charge, right? Sometimes they give you the short-term funds. They give you short-term funds, give you 80%, so that when they get the 100%, they'll bring you the 20% less any service charge, right? Any question? So with the factoring, we'll talk about two types. We have one, the non-recourse factoring, and then the recourse factoring. So with the non-recourse factoring, here the factors insure against, so the debt factors insure against bad debts, insure against any bad debts. Debt factors insure against any bad debts, right? But with the non-recourse factoring, there is no insurance. So no insurance against bad debt. Right. There is no insurance against bad debt. So here they ensure that you will not get any bad debt too. The non-recourse, no bad debt too. That one. But here any bad debt can occur, right? So that is it. So I think with this we can. Then you have to look at the benefit of using a factor. What do you think are some of the benefits and some of the disadvantages of using a factor? It's also a likely question. Benefit of using a factor. What are some of the benefits? When you use a factor, what do you think are some of the benefits? So there's a savings in internal administration cost, savings in internal admin costs. Why? Because the factors who administer the trade receivables what ledger themselves. Because now you are not supposed. You see, when you are going to get the receivables, you have to do some form of admin, incur some form of admin expenses, right? So now you're not going to incur any admin expenses with respect to the trade receivables, but then it will be on the factor because you've hired them to do that for you. So they will incur the cost themselves. So there's a savings in internal admin cost since the factor or the factors, since the factors administer the trade receivables, the trade receivables themselves, right? Then what other benefits do you get as a result of hiring a factor to take your receivables for you? Also, there is a reduction in bad debt. So with non-recourse, to be precise, non-recourse factor, with non-recourse factor or factoring, non-recourse factoring, there is a reduction. There is a reduction. There is a reduction in the cost. In the cost of bad debt. In the cost of bad debt. So because the debt, the non-recourse insures against any bad debt, there is what? A reduction in that bad debt, right? And also it can be a source of what? When you hire a factor, a source of finance, because they will give you 80%, not 80%, but I mean example, they can give you 80%, they can give you 90% or so, right? That, oh, you take this 90% of the money that you are going to collect so that you can continue with your operations, right? Because without the receivables, without the money, it will be difficult to operate. So they will give you the 80% or the 90% that uses to operate. When they are done getting the 100%, they will bring you 10% less any service charge, right? So a source of finance for what? For trade receivables. For trade receivables. A source of finance for the trade receivables. What else? All right, so this will be our benefits. Let's look at the disadvantages. So what are some of the disadvantages of using a factor? Disadvantages of using a factor. So once you are using a factor, what are some of the disadvantages? You pay interest for their service, right? So interest charges on factor what? Charges on what? Factor what? Finance. Interest charges on factor finance. So interest charges on factor finance are likely to be higher. Are likely to be higher than other sources of finance. You think the factors don't want money? Once they are giving it to you, their service charge will be higher than you going for a bank loan. So instead of you leaving the receivables like that and go to the bank and get some overdraft, you said you like the factor. It's likely that the factor charges, right, will be higher than that of other sources of finance, like getting money from the bank, right? So their service charge is usually higher. Then sometimes there's an effect. There's an effect on customer goodwill. Effect on customer goodwill, right? So the factor is unlikely to treat the clients or the customers with the same care, right? With the same degree of care like you would do on your own, like we the business would do. But the fact that when they go there, they say, bring the money, they will treat the customers harshly, right? Because they are not having any sympathy on you. It means because they know that the reason why the business or the entity engage them to collect the amount receivable for them is because you are trying to be stubborn, right? You are trying to you are refusing to pay the receivables or the money. So once the factors come around, they have no mercy. Give us our money, give us our money. And that would affect the goodwill that you have with the customer, right? It will affect the relationship. So they will not treat the customers like you would do, but they would be a bit harsh on the customers. And also it may lead to a shutdown of the credit unit in the business, right? It may lead to a shutdown. It may lead to a shutdown of the credit unit or credit control, the credit control unit for a period. Because now that we've had a factor, what is the use of the credit control unit? They would have nothing to do, right? So it may also lead to what? A temporary shutdown. So this is basically about factors and then invoice discount. Any question? If no question, let's quickly proceed to solve the question 3. We can now solve the question 3. I think you've already read it, right?
Yes.
Okay. So with the question 3, we are having what? A sales of what? 100 million. Is it 10 million? $10 million, right? We are having a sales of what? $10 million. And this $10 million, what is it? Okay, so let me see, factoring services. Well, this question is based on factoring. So we are having the sales, we are having the months 1, 2, 3, 20%. Then when we are considering whether or not to factor our debt. The factors will pay 100% of the debt after 1 month. Oh, okay. So they will pay 100% of the debt after 1 month. The fee is 2% of turnover, right? 2% of the sales. The turnover here means sales. As a result, we will be able to lose some credit control staff, right? So I believe this one is part of the disadvantages, right? Is this one part of the disadvantages? Hello?
Yes.
All right, so at saving 20,000, right? Losing credit customer, and it is saving us was 20. Oh, okay. So it means we are tracking some of the credit staff, right? And that is saving us 20,000 per annum. The company's bank overdraft is 18%. Calculate the net cost or benefit of changing the new policy, right? So cost of what is the cost of going for a factoring service? So we want to know the cost of going for a factoring service and the benefit of going for that. Cost of going for factoring service. Cost of going for factoring service. And a cost of going for factoring. Cost of going for factoring. So what is the factor fee? if you go for a factor, we pay some fees. What is a factor fee? Please, let's do this together. What is a factor fee? 2% of what?
Sales, which is 10 million.
2% of the sales, which is the 10 million, right? So 2% of that will give us what?
200,000.
200,000. Right. Okay. So let me put $1. Right. All right. What other costs would we incur if we go for a factor? Is that the only cost? This is a saving, right? So that will be part of the benefit. So I think this is the only cost, right? Then we look at the current, like the way we did for the first one, the current receivable what? Receivables before the factor. So current receivable before factor service. Current receivables before factor service. So we have the month. This one is in months. The first one was in days, right?
Yes, please.
So this one is in months. Take note. So month 1, month 2, and month 3. So what would be our average collection period? So we said 1 times what? Where is it? Let's know the receivable days. So 1 month times 20%. And then this one times what? 30%. This one times what? 50%. So what are we getting? This is 0.2.
Yes.
This is what?
0.6.
0.6. This is what?
1.5.
Yeah, 1.5. So what would be the total?
2.3.
2.3. But it is in months.
Yes.
So 2.3 months, right? Not days. Okay. So then what is our average receivable in months? This one will be in months. Average receivables in months. So average receivables, say that is the credit sales, right? Credit sales times the collection period over what? Over the 12 months. This one is in months. This one is in months. So collection period over 12 months. So what is the credit sales? 10 times. What is the collection period? Collection period is what? 2.3. All over what? The 12 months. What is our receivables amount?
1916666.67.
19.
Okay. 1916666.67. The 6 is 4.
0.67. So can we
The
make
6 is
here 7?
Yes.
6 is 1, 2, 3.
Yes. 6, 7. No.
Okay. Can we make here 7? Run it to the nearest whole number.
Yes. So you may make it 7.
Okay.
Yes.
So this is the current receivables before we hide a factor, right? Before we hide what? A factor. Now let's look at the new receivables the new receivables after hiring of what the factor, new receivables after hiring a factor, right? So after factor services. After we hire the factor, what is our receivables? We said the factor will pay us 100% of our debt after 1 month, right? So after 1 month, so the average receivables will be what? With the credit sales. What is the credit sales?
10 million.
10 million times what?
1 month.
1 month over the 12. 1 month over the 12. So what do we have? And they said they will pay us 100%, right? You see the other ones, it will be percentage. They will share the percent. The first one that we saw, it was 60% and then 40%. This one they are saying 100%. So we are using the entire 100%, right? So the entire 100% times 1 month, that is giving us what?
1.
Right. So what are we getting? After you are using 1 over. So what are we getting? Give me the answer.
833.33.
833.
333.
How many threes?
3.
How many threes?
I said 5.
1, 2, 3, 4, 5. Okay, so this is our average receivables after the words factor service. So what can we see? Comparing before and after is what can we see? How much is the before?
The before is 1,991,663.
And then the after is what? And the after is this, right?
Yeah.
So is it an increase or a fall? Is it an increase or a fall? This one is what? So there's a fall, right? So fall in receivables. What is the fall in the receivables? The fall in the receivable is what? 1,16,667 minus the what? 833,333 is equal to what? It's mommy, yeah. Mommy, yeah. The two mummies are here.
I think Vanessa has gone also.
Okay. What of mommy if you are here? Okay, it means she's not here too. All right. So what's the difference?
One zero eight
108
3334.
333. How many threes? 108
and 4.
So that will be what? 1 million, right? So there's a sharp fall in the what? In the receivables. So looking at this, is it just comparing this, the fall in the receivable, is it a good thing? Is the fall in the receivable a positive thing? Hello?
Yes.
It's a good thing.
Okay, so now let's move on to the benefits of the factoring. Benefits of using the factoring. We've already looked at the cost, then we look at the analysis of the current receivable without the factor, and then we look at with the factor. Now let's come to the benefit, and that will be the last thing. Then we compare the benefit to the cost to determine whether they should give the discount or not. Determine whether they should give the discount or not. So what is the benefit from the factoring? What is the benefit? Yes, what is the benefit? One of the benefits is to saving us of what, 20,000. As a result, we'll be able to lose some credit control staff at a saving of what, 20,000. So saving on the credit staff, right? Saving on credit control staff. Because once we hire a factor, there is no work for the credit control staff, right? So that will be staff wages, credit control staff wages. That is how much? 20,000. That is 20,000. What else? What other benefit are we getting from the factoring? We look at the benefit of hiring a factoring. What other thing can we see? We are also having in the what? The interest savings.
The overdraft. The interest savings.
The interest savings from the fall in the receivables, right? From the fall, we said the receivables was failed. So from the fall in receivables. So what is the overdraft percentage? They give us 18% times. What is the difference? The fall in the receivables. Fall in receivables, we had 1083333. So what then is our interest?
3334. 333.
4.
$195,000.
195,000. What are the benefits? Forget 0.1. Right, run into the nearest whole number. So what is What other benefits are they getting from the factoring? Is that all? So that will be all. So what is the total?
Because of the okay, that one. Sorry. Two 15000.
215,000. So will it be a net cost or a net benefit? So net cost or benefit? What the net cost or benefit? Is it 215,000 minus what? What is the cost? 200,000. So what is the difference? 15,000. So is it a net cost or net benefit?
Net benefit.
All right. So what do you think we should do? Therefore, should we employ a factor? Therefore, employ the services of a factor. All right. So example 4. So go and try the example 4. Or should we do that one? And we move to payables. Payables is like the receivable, the example one that we solve under receivable. That is the annual benefit with respect to discounts, right? Where we say the effective cost is what? 1 plus the discount percentage, 1 plus discount percentage over 1 minus the discount percentage. The payables is like it's the same as this. When you are calculating the effective cost, it's what? 1 plus the discount percent over 1 minus the discount percent all over the if 365 days over n, right? All minus 1. The payables is also like this. That's what where's the payable question? So the payable, they'll ask you to calculate the annual effective interest rate. Is like the receivable question we solved from, that is example 1. Is the same thing. So please go and try that under receivables, right? Under receivables. So you do for the two of them. You can send me your solution when you are done. Under payables. So we not come to payables, it's the same thing. The only thing we can say under payables is that the payables is also a source of finance. Trade payables is also a source of finance, right? But just that it is a free source of finance. Trade payable is a free source of finance because with a trade payable, you'll be taking goods from your suppliers, right? you go and take the inventory from the suppliers, and you not pay the inventory instantly, but then you go and sell it and get your money before later you come and pay. Once after selling the inventory, you can use the money, you can invest the money in other forms of securities, right? You can invest the money in securities. And once you invest the money in securities, you can get a return, right? So that's what I'm saying is also a form of finance. Because when you get the goods, you use the goods, you sell the goods and get your money, then you invest the money within a short period of time, you get some return before you go and pay the supplier. So indirectly, it is a source of finance, right? So basically, that is it about the payables. That is it about the payables. Go and try these two examples. Go and try these two examples. Then we will look at the cash budget. Look at the cash budget. So I think with example 4, they have changed this one. Yes, hello. Is someone calling me?
I was saying, yes. I was calling. So I'm saying that with the payables that we compare the overdraft with whatever we have before we decide whether to go ahead with it or not.
Come again.
So you see, mostly when they ask you the question, they'll say something, and then they'll tell you that maybe the company's bank overdraft is this percentage. So I'm saying that it's with the payables that we take that into regard before we decide.
No. It's not only payables. Receivables to the first question also. I'm sure you thought of the first question. It's based on information that you are provided with, right? Based on the information that you are presented with. Because this one, they just give us the overdraft, and then after computing the effective cost of discount, we compare it to the overdraft. Here we compute the effective cost, which we use this formula. And then the percentage that we get, we compare it to the overdraft percentage. Then we decide whether we should offer a discount.
It's only when you're computing the effective. So when you compute the effective discount is when you compare it to the overdraft. To see which one to take.
Exactly. Okay. But this one is a full question. So this one we don't just compare with the bank overdraft. The overdraft rate is just telling us the rate for overdraft when you are going for bank loan. That is the rate, right? The borrowing cost. So that rate will apply. That's what the same rate we use in getting the interest on the savings. So just know that this will be used when computing the interest on the savings, right?
Okay.
So this one with example, example 4, the same example. It's the same example 3. You can see that all the things are the same, right? Example 3 and 4. Just that here we are considering not to factor our debt, right? And so the factor will pay us 80% of our debt after 1 month. The factor will pay us 80% of our debt after 1 month. Look at this one. The factor will pay us 100% of our debt after 1 month. So that's why we said 100% times 1. We said 100% times what? 1. But this one, they said the factor will pay us 80%. That is 1 month, right? So 1 times 80%, that is for the first month. Do you get it? Hello?
Yes.
Right? And then the second one will be what? They are saying that the remaining will be paid what? 20%. Right? The remainder, where the remainder? They say the remainder, the 80% 1 month, the fee is 2%, there will be blah, 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 blah. All right. So here they didn't tell us when the remainder will be paid. So the remainder will be paid over the 3 months. Over the 3 months, right? So, or we assume that it will be paid at the last period. So that will be 3. So it will be paid. So if you multiply this, what are you getting? 0.8, right? What are you getting for this?
Zero point 0.6.
0.6. So if you add the two, you get the month. Then that will be whatever you have over the 12 months times the sales, 10,000, right? The 12 months, whatever you have here. What do you have here? What do you have here? So that's 1.4. So 1.4 over this will give you that, right? Aside that, everything else should follow the same format. Everything else should follow the same format. I think there is also a bad debt. Okay, here there's a bad debt. So the bad debt, will it be a cost to us or it would be a benefit?
Of course.
The bad debt, will it be a cost or would it be a benefit as a result of hiring the factor?
Of course.
No, it will not be a cost. It will be a benefit. As a result of hiring a factor, we have hired a factor to collect our debt for us. So we know that once we hire the factor would insure against the bad debt. So there will not be any bad debt because we've hired what? A factor. Do you remember the non-recourse factor?
Yes.
The non-recourse factor, we said they insure against bad debt, right? So we said the non-recourse factor insure against bad debt. Where is it? Non-recourse. Non-recourse factor insure against what? Against bad debt. So if we hire a factor, it means, and the factor is a non-recourse factor, and then it means there will be no bad debt. So now they've given us the bad debt of what? 3%. So this will also be part of the benefit because because we hire the factor would force and get our monies for us. If we had gone for the monies ourselves, in fact, some of the customers will not pay, they will run away. Some of them will go bankrupt and stuff, right? So because we've hired a factor and the factor are very strict, they will go for our money for us. So as a result of that, the bad debt will be saved. So bad debt will be part of the benefit. And that was 3% of turnover. So that will be 3% on the 10 million. 3% on the what? 10 million. So aside this changes, the question is the same as what? The question 3. Question 4 is the same as question 3, except the changes that I've made, which is the 80% here, but when you come here, it's 100%. So 100% times 1, and we did that from the previous calculation. When you come here, it's 80% times the 1, and the remaining, they didn't tell us when the remaining will be paid. So we assume the remaining will be paid for the 3 years, right? Or the remaining will be paid over the last day, over the last month. That is the assumption, right? So we would have to multiply 3 times the remaining 20% left. Then when we come to the benefits, we would introduce the bad debt because the bad debt has been saved as a result of hiring a factor. So that is it for the receivables and payables. The next thing will be cash budgets or our cash. Are you ready? Any question? Any question? All right. So if there is no question, we proceed.